Welcome, welcome. This is 𝐒𝐤𝐢𝐚𝐥, your money mindset expert. And once again, we have the amazing, the wonderful Joseph Hogue. Welcome, Joseph.
Cool. Thanks for having me back. I really appreciate it.
Thank you so much for coming back. We had such a wonderful conversation on Friday for each other. We had to have you back on Money Talkies. So, Joseph, everyone's heard your intro, but please, in your own words, tell everybody what it is that you do.
Sure. Well, I come from that venture capital equity analyst background, worked for private wealth management for many years. In 2014 and then in 2017 with YouTube, I really wanted to bring that experience to the Main Street investors, really, right? Get back to where I came from and, share my investing experience and my experience as an analyst with regular investors out there. So I love talking about stocks, love talking about investing and really, how to create that financial future that we all deserve.
Wonderful, wonderful. And so today's topic is how to stay sane in a bear market, which is very, very appropriate in the current circumstances. This episode is being recorded around mid of 2022. So I think it's important for us to put that in context if someone is listening in the future. But tell us, first of all, I think let's get everybody on the same sort of page. What do we mean? I mean, I know what bear and bull market is, but please, for everyone, just make sure everyone, the audience understands. What do you mean by bear market?
Sure. Well, we use these terms, right? Bear and bull market, just to kind of personify the way the stock market and stock prices are going. A bull market is, anytime stocks are making new highs, stock prices are going up. So not quite as well defined. A bear market, though, is very well defined. It's whenever stocks or the stock index, the market itself, is down 20% or more from its recent peak, right? So we actually just hit that today. Today, the S&P 500, so here in the US, the broad stock market index is down about 21% total from its November high. So we are now technically in a bear market on stocks, and that'll continue until stocks over a period of 2 or 3 months or so continue to go higher and eventually reach those new highs.
And I just want to let people know that in between we'll say bounce back, because there are some times when you stocks or actually any sort of markets, be it crypto or stocks or forex, doesn't really matter, but where certain things will hit a certain level and then they'll have a small bounce back, but you'll continue down. So it's a downward trend, but obviously it's in a straight line, it's up and down. So this is what we mean by bounce back.
And that's an interesting idea called a bear market rally, actually. When stocks do hit those kind of oversold levels and a lot of, technical indicators and that kind of thing where maybe investors sold out too fast and they're still optimistic. So they buy back in, they push stocks higher. But the fundamentals, those real big economic forces like, higher interest rates, runaway inflation, things like that really haven't changed. So the market still has that longer term downtrend, and it's really dangerous because it does draw more investors in as they start seeing stock prices come back up. They think, hey, this is the start of a new bull market. I have to get in. I have to get fully invested once again. They get back into the market, and of course, then it just sells off further into those lower lows. So extremely dangerous. What we've been seeing actually throughout this year, a few bear market rallies in that.
I think this especially happened with crypto, because I've been in the crypto space quite a bit, and we've had quite a few crypto rallies and people have come back in, and unfortunately it hasn't materialized because obviously as we speak at the moment, crypto is down the lowest it's ever been for since the beginning of, I think, 2021. So let's talk about this now. So you talk about the fundamentals. So let's start telling me, how can I, if I come to you say, Joseph, oh my God, the share market's down and crypto market's down and everything's going to pots. Tell me, how do I stay sane? And exactly, as you mentioned, at this moment in time, inflation has gone through the roof. It's just crazy. As much as I in my adult life have I been. I mean, it must have been high when I was younger, but I don't remember because we don't understand those concepts. But in my adult life, the inflation highest in UK since I have been for the last 20 odd years. The gas prices, which is for our petrol and diesel, is through the roof. Food prices are through the roof. Oil prices just to cook food is through the roof. So tell us, with all this uncertainty, what's going on? How does this all feed into the bear market?
Sure. Well, a lot of it is just kind of that what the economy is doing and how it affects investor sentiment. We talked about that technical definition of a bear market with stocks down 20%, but I think more important is just really the emotions that investors go through and how that affects stocks really. As stocks are going up, investors feel this feeling of exuberance, of optimism. Everything is going up. They're going to be rich, right? They're telling everybody about their investments. And then as stocks come down, and especially as they crash down, as they have done this year, then that changes to really almost the seven stages of grief. It is very similar to what investors go through for someone experiencing grief, right? You go through denial, where no, stocks are going to come back. They've always come back in the past. I just have to stick with it. You go through, anger, where you start blaming either the government or other investors for selling their stocks and driving the market down. And finally, you get to a sense of capitulation, where just, you're done with it. You just sell out of your stocks. You don't even want to look at your portfolio anymore. So it is a very clear and documented stages that investors often go through, that I think in one way, just understanding that those are normal emotions, those are emotions that all investors feel as stocks are coming down. It really helps you put it into perspective and understand that, yeah, I'm angry right now that the stock market is falling. I'm angry with what the government is doing and how I perceive that affecting the market. I have this sense of loss and sense of grief here, but that's normal. It goes through, every 3 to 5 to 10 year cycles for the stock market, and stocks will come back. So I think it's important to kind of keep that perspective. Beyond that, I think it's very important to understand kind of a counterintuitive point here, that, and it always surprises me that investors, they love pushing as much money as possible into stocks as the stock market is going up. As prices are going up, people are getting exuberant, they're getting optimistic, and see that road to riches materialize ahead of them. But then when stocks come down, when stocks prices fall, they panic, they sell out of their stocks at a loss. Sometimes they leave the market, and they oftentimes they don't return until the next bull market is well on its way, and they've missed out on a lot of those returns. So the counterintuitive idea to that is that now, as stock prices are coming down, this is actually the best time to invest. Investing on the way up, you never know if that's going to be the top in stock prices. You never know if stock prices are going to start to fall after you've invested. Now, as stock prices come down, you're getting a discount. You're getting a discount to what those stock prices were in the past. And eventually, if you look at any stock chart, any stock market over the last 60, 70 years, one thing is guaranteed. One thing is unanimous across all of those, is stock prices always go high. The stock market eventually recovers. It eventually hits new highs. So, if you are investing now as stock prices go down, you're getting a good deal. You're getting those future returns when the stock market does rebound. So I just want people to understand, don't panic out of the market. Understand that these are actually very great times to start investing and to continue investing, and to just do that. It is important to have a strategy though for investing. I think
we discussed the strategy off camera. Talk to us through this, because one of the major concerns that we have, I think any kind of self-taught or some kind of savvy investor knows bear markets are buying opportunities, and it's a great place to buy. Now, the question that comes to mind is, well, where is the bottom line? How do I gauge if the market's leveled out or is just taking a bit of a dip, and because normally you think there's a dip and there's a bit of a rally, and then you think, oh, okay, the market's going up, let me reinvest again. How do we, protect ourselves, outside of, these bear rallies, as you call it?
Sure. Well, it starts with having, always having kind of a diversified portfolio, and that's probably a lesson for another day. But having some real estate, having some bonds, having some cash, so you can take advantage of those as stocks dip, right? Because a lot of those other assets, especially cash, obviously, it's not going to lose its value as quickly as stocks when the stock market crash comes along. But that strategy of when to invest, and this isn't necessarily where you're trying to find a bottom. You're not trying to market time the market to its exact bottom. But you also, by the same token, I see too many investors just stress out over watching the market every single day as it's going down. Wonder, okay, is this the time? Should I put my money into work now? And what ends up happening, of course, is they get so frustrated at watching the market every single day, at watching their portfolio go down, at trying to second guess the market and trying to time the market, is that they just push all their money into stocks, thinking, okay, this has got to be the low. It's the stock market is down so much today. This has got to be the low, and I'm going to go all in on cash. And of course, that's never the low. The stock market keeps on falling, and now they're fully committed and they're losing money as the stock market goes down. So I think what's important here is to pick an index, the stock market index. Here in the United States, you might pick the S&P 500 index, which is right around 3,900 right now. And you say, okay, you know what? I'm going to hold my cash until it reaches, 3 markers, basically, right? So you can say if the S&P 500 is 3,900 right now, it's down about 20%. We know the average bear market or the average stock market crash is about 28%, in history back to the 1930s. So we can say, okay, if the market falls to 3,500 on that index, which would be about a 30% correction or 30% crash, then I'll invest maybe a third of my money, right? Or a third of the cash that I have available. If it continues to fall down to 31%, that would be right around a 35% drop from the peak. Then I'll invest another third of my cash available. And then if it falls further to maybe 2,800, and these are kind of arbitrary numbers, but you just need those markers. Then I would invest the other third of my money. And what this does is, one, it gets you invested at certain points, right? So say the market does fall to 3,500, you invest that third of your cash, and then it starts rebounding. Well, you've got your money working for you, and you can take advantage of those lower prices. You can enjoy the appreciation, the returns from that point. But if the market does continue to fall further, you've also got money set aside to take advantage of those lower prices if they do come along. So you've got really kind of the best of both worlds, right? You're taking advantage of the low prices by buying into stocks at a discount, but you're also holding some money back just in case the market gets worse, right? More importantly, though, I think what this does is it really gives you a formalized plan and takes that stress and the guesswork out of investing, right? You can say, okay, you know what? I don't have to look at the market every single day. I just need to know, where is the S&P 500? Has it reached one of my markers there? And what I'm going to do in that case, right? And this isn't necessarily to say that you invest directly in that index or in the broader market. You still have your own stocks that you really like, the stocks that you maybe already own in your portfolio, that you would put the money in those, right? So you're just using the S&P 500 or whatever stock market index you're using as a marker for when you're going to invest. Really, again, to take that guesswork out of getting back in the market.
Yeah, I mean, that's great advice, because I'm thinking, there's a stock that I just love, just because I'm a big Elon Musk fan. So obviously that would be Tesla. So and it just skyrocketed before I could enter. But now it would be a great time to at some point enter it, because I think, I haven't checked the market, but I'm assuming it'll be down like everything else. So you'll pretty much get a discount on all your favorite stocks. And obviously I know that Amazon did a 20-to-1 stock split on the 6th of June. So, but then that still will be down further, and there'll be a discount on that too. So, I mean, if you look upon this as going shopping, sure, and buying at a discount and eventually, but unlike, when you go to a supermarket or a mall, prices never come back up. We know eventually, because that's what historically we know, eventually at some point, we don't know the time frame, but 3 to 5 years or 7 years, the stock market would recover, and then at some will hit new highs. And then overall, I think there's an average. It averages out to 10%, I think, annually, isn't it? That it increases because of there's crazy increases and there's downfalls, but over average is about 10%, isn't it?
And what's really amazing about this is that again, people have that perspective that a stock market crash is bad, and it does suck to lose money. I've lost money on my account just as well as a lot of other people. But just a year ago or a year and a half ago, we were looking at a stock market and stock prices that were just ridiculously overvalued. Right, the stock market itself was trading for something like 30 times on a price to earnings basis, and a lot of the banks, a lot of the analysts, Morningstar, Morgan Stanley, JP Morgan specifically, were all calling for a future of below normal stock returns, right? They were all predicting right around 4% actually annualized stock returns over the next 10 years. And that's just basically because, okay, when that price to earnings valuation, and when those valuations have risen so much, it's really hard to see them rising any further. So basically the only returns we were going to get was from that sales growth, from the earnings growth. And that was going to be, right around 4%. So really suboptimal returns looking at over the next 10 years. Well, now that prices have come down so much and, could come down even further, we are back to, for the investments you make today and over the next year, you're back to probably getting those 10 or 12% returns annually over the next decade. So it's really, it's really kind of how you frame your perspective on a stock market crash and on a bear market. There are lots of opportunities here. And I just want people not to panic out of stocks and just to remember that. I think another very important point is, when I say I'm waiting for different points to invest, and really holding my cash and that kind of thing, I still have that habit of depositing money into my account every month, right? I think it's so important to continue to keep that habit of taking some money out of your check, taking some money out of, wherever you're getting your income, and putting that into investments every single month, not necessarily buying anything with it, but just building up that cash so you can take advantage of those prices. But I see too many investors, they sell their stocks or they stop depositing any money into their account because of the panic, because of the stock market crash, and then they just wait for so long to actually to reinvest, to get back into investing. One, they wait till basically the bull market is back up 15 or 20%, and they've missed out on a lot of that. But also they've lost that habit, and it just makes it so much harder to get back into the habit of saving and investing. Right, that idea of lifestyle creep that we talked about in our other podcast. Their expenses have grown, along with their income, and now it's so much harder to save that money back to invest. So just keeping the habit of investing and depositing that money anyway.
I think that's very, very important. I mean, one of the things that I teach because I work a lot on money mindset, is we have what's called 3 steps to cash flow mastery, where a certain portion of your money goes into investments. And you put them aside and you start, doesn't matter where you are, you start with 0.5%, 1%. In the initial days, it's very low amounts. You think, what's this as an investment? It's just getting into the habit of taking money out. And as your money grows, because your money will grow, and that's the whole point of the strategy. But once money starts growing and you stick to that strategy and eventually get to 10% of your income going towards investments on a regular basis, that can over a period of 5-10 years can amount to a certain level of money.
Oh, amazing. Yeah.
And but also in the process, you've made this habit of making sure that whatever income you get, 10% is always going to go towards the investments, and that investment goes straight away into obviously diversified portfolio, but whatever investment you have. And I do highly recommend diversified portfolio, and I'm talking from experience because I am a person who likes risk, so I lose a lot of money. And I recently just pull myself back and thought, no, I'm really going to put my emphasis on a diversified portfolio. Doesn't matter how sure I am and things are going to work and things are amazing, just don't take that risk and have a diversified portfolio for the long run and have a long-term picture. But that's another conversation for another time.
Sure.
But I think developing those habits when you don't have much, and then continue with them as your income grows, because the income will. And if we live in a productive society and we are finding ways to increase our income, which I recommend everyone to, this is what the reason of the podcast is, the money mindset. But as your income grows, you need to curb your expenses and make sure that the money is not going towards an additional Gucci pair of shoes, but it's actually going towards investment that's going to give you ROIs.
Definitely.
Gucci shoes is probably the wrong example, because they're becoming collectibles, and you probably can make money on those as well.
Turn them into an NFT or something.
Nowadays,
sure.
Sometimes I think certain rare bags, I know the Gucci bags or whatever, the expensive ones, the rarity ones, they become collector's item and they're 10x their value or something ridiculous. So I was told, I'm like, oh really?
but even more so, I love the idea of just starting with whatever you have. you know, even if it's 0.5% of your income, just getting started. Because one of the other amazing ideas within finance, within investing, is that idea of compound interest, right?
Yes.
And that idea of time, using time to your advantage. There's a reason why Einstein called compound interest the eighth wonder of the world, right? Because you know, as you save that money, even if it's just a little amount, that money starts making money for you, and starts just building and snowballing into larger amounts. I think I read a statistic a couple weeks ago that Warren Buffett, you know, at one point the richest man in the world, and still doing very well.
Very well, yeah.
He has made more money since he turned 65. I think he's something like 80 now. So in the last 15 years, he's made more in the last 15 years than he did in the 50 years preceding that, just because he's saved up. And it's not because of, you know, huge investment returns, right? It is because of that compound interest. It is because, you know, when he turned 65, he had something like, you know, $50 billion. So even if you make 10% on $50 billion, that's still $5 billion a year that he's made, right? And he's only made that because he started 50 years, you know, well, when he was 15, basically, he started investing. He started putting just a little bit amount of money each month to his investments, and it's compounded every month, every year since then over those 50 years. So just an amazing idea in compounding interest, and just amazing to let that time do its work for you.
Absolutely, absolutely. Well, on that note, we're going to wrap this up. So what would be your final thoughts or ideas to someone in terms of staying sane in a bear market?
Sure. Well, I would say, you know, just change your perspective on the market. Yes, it does suck. It does hurt. It's painful to lose money, but understand that right now is the best time to invest. If we look back, you know, Amazon went public in 1997, I believe. You know, got up to about $100 a share, then fell 95% to under $6 a share by 2002. And you were just talking earlier, it did that 20-for-1 split. At one point, though, it was up to about $3,000. Yeah, $3,000 a share. That would be about a 50,000% return, I believe. Basically 50 times your money. You know, if you had taken that perspective, bought shares, you know, in 2002 when everyone else was selling, you know, so just understand you're getting some great discounts right now in stocks. Stay with it, you know, keep that savings and that habit mentality, investing in stocks, and you will do well.
Fantastic. Thank you so much. And so Joseph, tell us, how can we connect with you? Where can we find you on the internet?
Sure. Well, I love to see everybody come to the community there on Let's Talk Money on YouTube. You know, join the community. I love talking about stocks, love talking about investing, just like what we've been talking about today. You know, so stop by Let's Talk Money there on YouTube. I also have a blog called My Stock Market Basics, really a little bit more of a basic idea on stocks, trying to make investing easy for everyone and really get people back to those core basics of how to start investing and how to grow your nest egg.
Fantastic. Fabulous. So if you are listening to us on the podcast, we will have the links for Joseph on the show notes. And if you're watching us on the YouTube, then down below in the description section, we will have his links too, and obviously the link to his YouTube channel. He is awesome, and I will be following him. So, you know, do check him out. Thank you so much for your wisdom and your time today, Joseph. It's been a pleasure talking to you.
My pleasure. Thanks, Gull.
And thank you for listening to me and Joseph. I hope you enjoyed today's episode, which was on how to stay sane in the bear market, which is very appropriate under the circumstances. I hope you enjoyed it. But do join me again. I will be back with another amazing guest on our Wednesday Money Talkies. I'm asking them for their expertise and their advice so that you and I can build a better business. Until the next time we meet, this is 𝐿𝐤𝐚𝐧 signing off. Take care and bye for now.